Walmart continuing to trim back parts of its e-commerce business, selling direct-to-consumer brand Bonobos for $75 million. That's a far cry from what it paid for it. Our retail reporter Melissa Repko joins us to discuss why.
It's selling Bonobos really at a time that it's been unwinding a lot of these different direct-to-consumer brands. It recently sold Moose Jaw, an outdoor brand, to Dick's Sporting Goods. And it's really a continuation of some of these D2C brands having a bit of a reality check with their value. And a lot of them are going to things like brick and mortar. So with Walmart, they really haven't done a whole lot with Bonobos since they bought it years ago. And
for more than $300 million, and now
yes,
they're selling it for $75 million.
Yes, exactly. A big drop for them. But when I spoke to Walmart yesterday, they were saying that they really found there to be some overlap with their brands. Last year, they had launched a Bonobos extension of the brand in their stores and on their website. And they just thought that it was too similar to what they already carried. So they're selling it off now, and they're really focusing on the basics of e-commerce rather than the shiny
But
brands.
Bonobos was not merely an e-commerce brand, was it? I mean, I've seen them in Nordstrom. I've seen them in other stores.
Yes, Bonobos was one of those names that started out as direct-to-consumer, but then found it was really hard to operate without locations. So they opened up stores that acted more like showrooms. A lot of those sales actually happen where people leave without the item and get it shipped to their home.
And we should add, this is hardly Walmart's only e-commerce fray that didn't quite work out. They shut down Jet.com after paying $3 billion for it. There was a smaller New York-centric delivery site. I can't remember the name of it. They've done a...
Jet Black.
Jet Black.
Yes.
And
exactly.
they've done a number of these. I don't know if they finally said enough is enough, because the core business actually has done quite well. It's all of these acquisitions that haven't panned out.
Exactly. It's worth noting that e-commerce has grown dramatically, and a lot of that came from the pandemic. So in January of 2020, which was right before the pandemic started, e-commerce drove about 6% of their overall online sales for Walmart US. That's grown to 13% as of this January. But I think Walmart changed its approach. It really started thinking about how it could use some of the fundamentals of its business, like its stores, to lean into faster delivery, fulfilling orders at a lower cost. And again, kind of shifted away from a lot of these companies that it bought under Mark Lowry, Jet.com's leader. He left in 2021. And during that time, a lot of these brands were thought of as the future of e-commerce.
And now it's, they weren't. And what's interesting about this is also putting pressure on Amazon. In his shareholder letter, Andy Jassy talks about the cost of kind of that fulfillment to the household, if you want to call it that. They need to get better at it. And this competition from the Walmarts and the Targets and their model is fascinating.
And that same message carried over to Walmart's Investor Day, which was last week. Similar to what we're hearing from Amazon, Doug McMillon of Walmart said the focus is really on driving a profitable e-commerce business. And that will come from things like automation, which it's really pushing into. It's all about making money now, not just driving sales higher. And a lot of these DTC brands like Bonobos were known for growing at all costs, but not necessarily making money.
Well, yeah,
making money.
You can
at the
juice
end of
the revenues,
day.
but at the end of the day, what you want to do is make money. Melissa, thanks. Have a great weekend. Melissa Repko.
Thanks, you too.